Good afternoon, traders. This is Trader Tim from over at eminimind.com doing a trade recap for the 3rd of September 2020. For those that have been following along with at least the last handful of weeks of these videos, hopefully you were able to capitalize pretty big today, being in the form of having that hedge on your long positions. It's funny, I put a little tweet out this week just commenting on how 2020 has been such a amazing year as far as P&L wise, my biggest year thus far, and we still have 4 months left. My biggest year in about 15 years of doing this, and I got a lot of comments back and questions about more of the long-term investing and hedging strategy versus my ES day trades. So we'll get into the ES trades from today. I had 2 trades. We'll talk about those, and then but before we do that, the whole concept of buying insurance when the market is really strong, so that if the market pulls back, we can capitalize on that down move. Our long-term positions, we're not tied to closing them out and then having to re-enter the entire position. Rather, having that hedge in the form of puts. Sure, our long-term positions might temporarily pull back, but you know the stock market as a whole goes up. I mean, if you go back 100 years, the trend for the market is to go up. We dollar cost average. You can contribute to your retirement accounts and whatnot, and continuing to buy some of these investments, and then you build enough wealth up, and the interest alone, can sub out a salary or some sort of supplemental income. So one thing I wanted to note about the hedge is that when the market goes up, 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 like it did this last week, where really the last 2 weeks, where it's just gap up, go. Every day is just a monster continuation. What I do is I will roll out of some of the lower price strikes. So if I go over to the SPY, just so we can talk exact numbers. So back when we came up and hit the negative 23% target, I picked up some 330s, and I even had some 320s. And those lose a little bit of value as we go up like this, but volatility was so low that, I mean, you're barely losing anything as far as total cost goes. So let's say you lose $20 on a $200 or a $2 contract, 20, 30, $40, you're really not out anything. But if the market goes down, that $2 contract can turn into $2,000 contract. So as we were getting up last week, closer to the negative 61.8 target, I took those 320 and 330s that lost a little bit of money, but not much, and I closed those out, and then I bought higher. So I picked up some 340s and 45s, and that allowed me to get a little bit higher strike, so that as we get the sell-off like we did today, you don't know when it's coming, but at least it brings up your sort of reward potential by having the higher strike price. So if I go from the high, from back here, the anchor point from this traditional retracement, and if I go from high to high, we can see that 50% is a 341 on the SPY, and so that's where, that's how I kind of get the 340, 345, even a 335, somewhere in that strike range is kind of what gives me my target for the pullback. So you could certainly, buy a cheaper contract or, a handful of contracts at 320, 330, but they're not going to be quite as robust when you do get the sell-off. So then the idea here is that I like to close out positions and put them on at the end of the day. And I'm not going to close out the entire position here, because I think we have a potential for at least some sideways or maybe a little bit of of a little more of a dip, but take a little bit of profit. And they're so cheap that you can buy 10, 20 contracts easily, and it doesn't really cost you much. So just wanted to touch on that before we get to the day trading stuff, just because I had a lot of questions, and in the last handful of videos, I went into more detail on that strategy as well. So S&P, we're at the negative 61.8. That's a very extended target. The negative 23 is the standard target. If we go to the Dow, however, we can see we are right at the negative 23. The NASDAQ is actually beyond its 61.8, so we can do the same thing. A traditional retracement is a low to high. Well, now that we've gone so far beyond it, we can draw an extension from highs to highs. And we can see that's kind of where we're at least pausing today. We have about 10 minutes till we close. And then the Russell. And the Russell didn't make it to its negative 23% target. I have this uptrend line drawn. We actually broke below it and below the swing low back here. So that's fairly bearish for the Russell, but it's still a consolidation if you look at it from kind of this being a bull flag, as far as we could draw a rectangle around this area. So we haven't had a major pullback in the Russell, but certainly more relative weakness compared to, say, the S&P. So all of these markets are basically at longer term targets, high targets, and so a pullback shouldn't really surprise anyone. I think it surprises a lot of people who get sucked in to, if you're a newer trader in a bull market like this, and you think, well, the market can't go down, it can certainly catch you off guard. But you get these sell-offs like this, even if they're just short-lived, a couple of weeks or even just a couple of days. It's a great opportunity to be able to um, capitalize on the downside, and then maybe get into some swing trade longs. Perhaps if you're building up some more cash in your longer term accounts, you can use that as a buying opportunity. It's not so critical where you buy in the longer term, because let's say you bought here on a breakout of, let's say, 325. I mean, that's cheaper than where we currently are at a 341. So as far as like the dollar cost averaging goes, it's not as critical as you might think. The idea is, especially if you're younger, just to be able to pile up cash, and then every couple of months be able to, invest that. And when you get a really nice run up, then you can do things with that cash and have more opportunities to find sort of those diamonds in the rough, if you will, by being able to spread out your positions and have, lots of different things going at one time. So let's shift gears a little bit and go over to the ES. If you do have questions, feel free to put them in the comments below, as well as every Tuesday, if you're interested in following along with the live trading session, you can ask questions there, and you can find out the link for that is over at emoneymind.com/VIP if you want to be in a more interactive, real-time question and answer environment. So as far as today on the ES goes, the first thing I did was to mark the low of yesterday. We had this gap down, and we hadn't broken the prior day's low, on this whole run up. So breaking that low would be significant. One thing I did want to highlight also is on the SPX, two things actually. The SPX, if we look at the gaps, we have filled these top couple of gaps. I think we can get down to basically a 3400, 3397.16 is the actual gap. I think we can get there, fill that one, and then bounce. I mean, uptrend clearly intact if we just kind of connect some of these lows very, generally like that. So really, this sell-off today is not by any means scaring me too much. And then the second thing was just the VIX. We have a little spike in the VIX, but if you go back to like end of June, middle of June, and then we compare that to the S&P. I mean, we were way down here. So we would really need to see a monster move in the VIX to kind of give us some more oomph and continuation for a sustained sell-off. But I'm always watching the prior swing low back here, and if we do sell off and break it, I'm totally fine drawing up a short from highs to lows and seeing if there's a reaction at the 50%. So that's kind of always the same program or process that I follow. It just you have to come down and break a swing low first for that to kind of initiate. So as far as the ES goes today, the morning was a little bit sideways or very much kind of sideways, and there wasn't a lot to pull from. But after we get about 20 minutes into the day, I like to look for a full halfway back. And so sometimes you start the day and you just have a retracement, and then from that anchor point and that 50%, you get the next retracement and the next retracement. Well, about 20, 30 minutes into the day, you usually see a full halfway back, meaning drawing the high to low of the day or low to high of the day. So it's a little clustered on my chart on this 5 minute, but this is how I drew it from high at the open down to lows. It was about 650, 655 was where that low was pulled from. And then we set up in the short. We traded at the 50% on the 5 minute. And then it's just a matter of coming over to the 512 and drawing up a smaller setup for your entry. If we zoom in a little bit, we can see here that we didn't break the swing low. So this wasn't a valid short. This next one here, same thing. We're kind of retesting the 50%, and that's that 50% that's visible over here on the 5 minute. But we didn't break the swing low, so you can't really draw a short like that. If you did, you'd end up being stopped out. But what you want to wait for is the break of the swing low. And then, so down here, we broke the swing low here as well as here. And then you can draw up your short and then just round down 56.25 as your entry. And then you're in the direction of that same 5 minute short, and then down we go. This one got a little tough to stay in, like for the second leg down. I ended up doing here is just coming in and drawing the retracement from this little candle's high to lows. If you would have just put your stop a tick above the candle's high, you would have been taken out. There really wasn't a great option to hang on to that rollover unless you went from lows to lows, and you would have had your stop 6, 7 points away from where price was. So it's still a about a 10-point move. And on these big days, you can look back and say, well, gosh, I should have, wish I would have been able to capitalize more. But, it's not so much about getting the whole move. It's just a matter about being able to be consistent and catch, occasionally catch these bigger moves. And then on the 5 minute, the only other opportunity for a short that I saw early in the day was to draw the extension from lows to lows. So if I zoom in a little bit, maybe they'll clean this up. We have the high to low 50% retracement. We come down to the negative 23, and then once we come down to the negative 61.8 here, that gives you the go ahead to draw the extension short. And you could draw it like that and use try and get in something like over here. But even that was a little bit of a stretch. Once we came down and broke lows of yesterday, down here, things got kind of interesting. We didn't really have any low ticks that lined up with lows until about 7:24, so that'd be 10:24 Eastern time, and that was the second one that I had here. It was actually a long. It happened a little bit quick, but we did put in a little swing high and just drawing from lows to highs, pull back to the 50%, and I ended up doing kind of the extension long here and got taken out underneath that 61.8. It was a short-term bounce. We did have a low tick at lows, which is why I went for the counter trend. We had also just broken yesterday's low, and lately Up until today, we've been seeing sort of that intraday V reversal. So I was just kind of taking that same play. But then today, obviously, we kept going lower, and so that's where those puts come in handy. And you know, you're capitalizing pretty big when you get the sell-off like that. But more importantly, when the volatility kicks up, because the option prices inflate with more volatility. And that's why buying calls uh, sometimes aren't always the best way to go, because if you buy calls at low prices when volatility is really high and then the stock goes up and volatility contracts, that option price can really shrink. And so I'm a big fan of just buying the underlying stock, as well as shorting if I'm swing trading. But as far as hedges go, the put option creates that asymmetrical risk. So you can risk a little and potentially make a lot. So I hope that was helpful. If you have questions, feel free to leave them in the comments below. And I hope everyone has a great rest of your week. And we will talk to you all soon.